I can't tell you when this collapse will happen, or how violent it will be, but I assure you, we will have a crash. That stark warning wasn't mine. It came from the American author and journalist Andrew Ross Sorkin just a few weeks ago in an interview on 60 Minutes. It was his answer to the question, will the U.S. stock market crash? The U.S. stock market has soared to historic highs in a rally that many professional economists view as unjustified by underlying economic fundamentals. The truly unusual, and frankly precarious part of this rally is that it's almost entirely driven by a single sector: artificial intelligence. The vast majority of the massive growth in corporate market capitalization in the US is the result of investors placing epic, record-breaking bets on AI, pouring hundreds of billions of dollars into this one area. This intense, singular focus has created a new term dominating Wall Street: the AI bubble. Today, we are not here to predict a crash. We are here to conduct a deep analysis of the structural risks embedded in the market. We will use data and expert testimony to educate ourselves on how this concentration of wealth was formed, why it looks like a bubble, and what the consequences could be if the optimism does not materialize. Welcome to WiseWolf Economics, where we break down the numbers simply and wisely. Let's begin by examining the kind of investment frenzy that defines a bubble. When an investment theme becomes dominant, logic often takes a backseat. Consider the story of Thinking Machines Lab, founded by Mira Murati, the former CTO of OpenAI. When seeking funding, her startup, founded in February 2025, essentially presented a vision rather than a product. One investor, speaking to the information, described the pitch as remarkably vague, noting there were few concrete details shared about the product or service. Yet, by July 2025, Thinking Machines Lab closed on an outsized early-stage funding round, raising an incredible $2 billion at a valuation of $12 billion, a historically high figure for a company at the seed stage, with no commercial product in the market. This example, while impressive for the founder, is a classic symptom of market euphoria. Investors are rushing to back anything with the words artificial intelligence attached, fearing they'll miss the next big thing, even if the fundamentals are absent. The belief is that AI will spark a technological revolution comparable to, or even greater than, the Industrial Revolution, making its eventual payoff limitless. This belief is what fuels the outsized influence of a handful of companies. Let's look at the numbers that illustrate the market's concentration. The soaring US stock market is not a reflection of a universally booming economy. It's a story of concentration. The group of companies often called the Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and Nvidia, are responsible for the overwhelming majority of the massive market cap increase we've seen. Their collective value now stands at tens of trillions of dollars. According to analysis cited by the financial institutions, these 7 companies, along with a few other major AI players, were responsible for roughly 3/4 of the total returns achieved by the S&P 500 during the recent rally. In essence, the main US stock indices are rising to record highs, not because 493 other companies are thriving, but because the optimism surrounding AI has given a small group of tech giants seemingly unlimited valuations. This creates a market where all the eggs are in one basket. The books tell us the stock market is a mirror of the economy, but in this case, the mirror is reflecting one single, dazzling, AI-powered spotlight, obscuring the rest of the room. But what if the promises of that spotlight don't materialize? For a market valuation to be sustainable, it must eventually be backed by real-world revenue and profits. This is where the red flags appear. Recent academic research challenges the fundamental assumption that AI is automatically translating into profits. A widely discussed report from MIT suggests a stark disconnect. The study indicates that as many as 95% of enterprise-generative AI pilot projects are failing to deliver a measurable, positive return on investment. The core issue? Many organizations are not seeing the revolutionary productivity gains that justify the massive investment. Instead, some studies suggest that AI tools are being used by employees to create busy work or content that looks good but lacks the core substance to drive real commercial progress. If the foundational belief that AI will fundamentally revolutionize productivity and therefore create immense new profit streams is weakened, the entire valuation structure built upon that belief becomes unstable. Even figures at the epicenter of the AI boom are recognizing the problem. Sam Altman, CEO of OpenAI, has publicly acknowledged that the industry is currently in a phase of exuberance, admitting there is hard to say we're not in a bubble of some sort. Why should a potential US stock market correction worry the world? Because the global financial system is now more exposed to US equities, particularly tech stocks, than ever before. Gita Gopinath, former chief economist of the IMF and a Harvard professor, wrote a serious warning in The Economist. She estimated that a market correction of a magnitude similar to the dot-com crash could wipe out over $20 trillion in wealth held by American households, an amount equivalent to roughly 70% of the US GDP. Even more critically, she warned that foreign institutional investors could face wealth losses exceeding $15 trillion. Gopinath argues that unlike the year 2000, today's global economy is far more fragile, facing factors like tariff wars, high government debt, and limited fiscal space for governments to stimulate the economy after a crash. Her conclusion is sobering. The next crash is unlikely to be brief or soft. What we are analyzing is a market structure defined by extreme optimism, concentrated in a very narrow band of companies. And that optimism is running far ahead of proven, measurable profitability. This is the definition of a speculative bubble. The lesson from history is clear. Markets are cycles, and the bigger the boom, the more challenging the eventual downturn. The risk is less about if the correction comes, and more about how the world's interconnected, debt-laden, and politically strained economy will handle it. This brings us to the core question. Will the fallout from the AI bubble permanently relegate the US economy behind its global competitors, or will American innovation prove resilient and keep it in the lead? Thanks for watching WiseWolf Economics. Subscribe and join the pack. Be a wise wolf.